Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically sitting in with me would typically be Mr. Michael Becker, the governor of Beckerville. He wasn't able to make it in today. He's actually out in Ireland having a wonderful time celebrating one of his birthdays, one of his large birthdays with his beautiful wife in Ireland. So hopefully he's having a Guinness on our behalf, having a good time. So sitting the podcast today, it's James Eng and Dave Walls. Guys, how are you?
Great. Thanks for having us, Paul.
James, what's going on in the Old Capital world?
A couple things. I mean, we just wrapped up our big conference, our once-a-year conference. And so thank you guys for everyone who came out to that event at AT&T Stadium. We'll have a couple of maybe recaps for people over the next couple of months. But in the meantime, we're going to be out in San Jose. So the next event will be Paul will be out in San Jose on Thursday, October 25th. And so go to oldcapitalpodcast.com to register for that event.
That's going to be a fun one. That's actually in San Mateo, California, just outside San Francisco. So in kind of a new venue out there, we are celebrating powerful women in real estate. We'd love to see you, powerful women in real estate, whether it's your sister, your mother, your aunt, somebody that wants to know a little bit more about investing into real estate, specifically multifamily real estate. We're going to have three powerful speakers up on stage and one kind of guest speaker, which I think you'll enjoy the heck out of. And so the three powerful women will talk a little bit about individually of how they got into multifamily, what they're doing right now, and how exciting it is to be in multifamily. So come out and see us, but go on to the Old Capital Podcast website and RSVP for that event, and we'd love to see you there. So I want you to listen to this real quick clip.
Hey. Let's be careful out there.
So does that sound familiar? Were you watching TV in the early 1980s? The speaker was Sergeant Phil Esterhaus. Sergeant Phil Esterhaus. And I don't know if you remember that name at all, but Sergeant Phil Esterhaus, and his quote really is, let's be careful out there. Hey, let's really be careful out there. So the context is the line was spoken by Sergeant Phil Esterhaus, played by Michael Conrad, in the TV show Hill Street Blues, and that was on between 1981 and 1987. So every week, Sergeant Esterhaus would gather the cops of Hill Street together and let them know all about the crime in the area. Crime they needed to stop. Murders, robberies, rapes, prostitution, arson. You name it, these boys in blue dealt with it. As he finished up his roll call for the day, he bid his officers farewell with this important advice. Let's be careful out there. We sure hope that they followed that. Today, we are using the same advice. Let's be careful out there in apartment investing. So today, I'm the old sergeant, and you are my rookies. And I want to have a discussion on what's happening out there in the market and how to react. So I want to have you hear what our opinion is and what we're seeing in the capital markets and what, if anything, can be done. So in the last few weeks, interest rates have spiked up. So if you've gone into CNBC.com or gone on BankNet or anything that has the ability to take a look at the graphs and charts of what's going on, we've seen the 10-year Treasury rise. So in Fannie Mae and Freddie Mac, we use the 10-year Treasury. And today, as we record this, it's right around about 316, 317. But about a year ago, it was at 2.318. 2.318. That's where the 10-year Treasury was. Last week, on Friday, it was at 3.248. So and today, about 316, 17, 18 in that. So we've seen it rise tremendously. So it's kind of a hockey stick where it started slow and then all of a sudden it's going up really quick. So in home lending, 1 to 4 units, the increase of interest rates makes the debt, it becomes more expensive. In commercial lending and apartment lending, an increase in interest rates make the debt more expensive. But also, this is the key thing, also can bring down the amount of debt available. That can go down significantly. I mean, a reduction in the amount of money you can borrow. So here's an example. So on a home loan, and a lot of people are kind of familiar with home loans because that's pretty easy to do. In October of 2017, the 30-year fix was around 3.85, And today it's about 4.71 or even higher. So a $300,000 loan amount with annual payments last year was about $16,877. Again, that's annual debt service on your house, just the principal and interest. A $300,000 loan today, annual payments are about $18,691. So the difference is about $1,815, $1,815 or $151 more a month. But lenders will not usually cut your leverage back, just make your payments higher. So monthly payments are going to go higher. So your personal income should be able to support it. In apartment lending, and again, I'm going to use a much bigger number to show my point. I'm going to use $5 million in a 125 minimum debt service coverage ratio. Fannie uses the 125 debt coverage ratio to qualify people. So again, debt service coverage ratio equals the net operating income divided by the debt service. So net operating income divided by the debt service. So let's say Mr. Jones is looking at an investment property with a net operating income of $36,000 and annual debt service of $30,000. The debt coverage ratio is for this property would be the 1.2 because Mr. Jones would know that the property generates 20% more than is required to pay the annual mortgage payment. So if the mortgage payment is $30,000 and the income is $30,000, the debt coverage ratio would be 1.0. So the 20% is what is the income and the profit to pay the mortgage payment. So again, on a $5 million loan amount with a 125 debt coverage ratio, that's what we're going to use. So in August of 2018, apartment interest rates were about 4.85 in that range. So payments were about $26,384 a month or $316,000 a year. Today, in this apartment interest rates have jumped to about 5.5 or so. So payments have gone from $26,384 down up to $28,846 or annually $342,000. So that's about a $25,943 increase in annual debt service payments. So that's pretty easy to understand. So if interest rates go up, your payments are going to go up. So from 4.85 up to 5.5 or so, your annual debt service is going to go up $26,000. But here's the part I really want you to understand. When we originally underwrote the transaction, we used the lower interest rate of 4.85 with that 125% debt coverage ratio to get the max loan dollars to $5 million. And on Fannie Mae loans, we typically will not lock the loan until the loan is approved by the lender, by Fannie Mae, and the borrower is issued a loan commitment, which may take 45 to 60 days. So here's the problem with interest rates going up. And it's for us and Fannie Mae that we still use the 125%, 1.25% coverage. So we're going to have to cut loan proceeds. So how much? Let me give you an example on what type of an impact that would be. A $25,943 or $26,000 increase in debt service, when you use a 6% cap rate, will cause your loan amount not to be $5 million, but it will be $4,567,000. It's a reduction of loan dollars by about $432,000, or meaning that you'll have to raise another $432 from your limited partners. So the same increase in debt service, let's say you had a 5 cap, again, we talked about 6 cap, but at a 5 cap, it'd be a reduction of loan dollars by $518,000. So yikes. So if the cap rates decline, interest rates go up in this, your debt service is going to command that you have a lower balance of the loan that we're going to approve. So that's kind of what I want to talk about today is the impact of what increasing interest rates can do to transactions and something to be aware of about what's going on right now and something how we can mitigate things in the future. So James, I'm going to kind of kick it over to you and let's kind of have a little bit of a discussion.
Yeah, so just in that example, the additional $500,000 that you're having to bring to the table as the equity, I think it's not just the amount of money you have to raise, but then also now your return on equity, which let's say you were originally projecting maybe a 70% return of equity over 5 years, so maybe a 70% return. Now that goes down to 65%. And so now you're having to go out and raise additional equity, but then it's at a lower return. And so that's the challenge, that not only you're getting a lower loan amount, but then your return on equity is lower. And so you're having to sell that to more people, which can sometimes be difficult.
That's a tough thing, especially in today's market itself, because our cash on cash yields are kind of X and people are expecting X. And when you probably thought that you were going to buy this property, you thought how much money you were going to need to bring in to have enough equity to buy this property and enough money for rehab, enough money for closing costs, and all of a sudden the lender comes back after interest rates go up in the middle of the transaction, comes back and says, hey, listen, James, I need another $500,000 more in equity. People are starting to scramble to do that, and that's what I think we're seeing right now.
And so we're in the middle of many transactions right now. And the question I'm getting from general partners is, how do I present this to investors then?
Yeah.
Right? Because the loan application, let's say, says 5% or 5.25, but then the rate is not locked on a Fannie Mae deal. And so my recommendation was to show maybe a base case and then have some alternate scenarios, because you're not going to know exactly what you're going to get. But you want to get people comfortable, because when I'm looking at investing in a deal, typically it's not going to be basis point driven where, well, this is 75% total return versus 80%. Really, I'm trying to get a feel for the sponsor, get a feel for the story of the deal, and then the overall return is sort of third on the list if I'm comfortable with the general partner. And so I think people need to show those scenarios, because it could happen on a deal where you were quoted $5 million and now you're at 4.6 or 4.5.
What are people doing these days, James? I mean, so the deal that we thought we were getting at the beginning is changed, and now you're asking us to bring more money to the table. In some real situations, we're going this direction in the big battleship of Fannie Mae, and all of a sudden interest rates, which doesn't affect really the transaction, but it can affect the debt service, as we talked about, and it's going to impact the loan dollars. What are people doing these days?
You mean in terms of general partners? What are they doing to mitigate that risk? Or
general partners for one, and then also two, are they making decisions to get out of Fannie Mae and maybe think about doing a bridge loan?
So there's a couple options. I mean, obviously Fannie Mae is not going to lock probably till 30, maybe 45 days into the transaction once all the reports come back. If the loan amount is under, let's say, $7.5 million, some people are going with the Freddie Small Balance Program and being able to lock in your interest rate at loan application instead of going further into the transaction. And so that's giving some people some comfort. But, a lot of the deals I'm working on right now are just Fannie transactions. And so there's one deal that we worked on, and we essentially got it locked within 30 days from loan app. And that is really hustling. You get the third parties out there and moving as quick as possible, and making sure that, Fannie has a program called Streamline Rate Lock, where you can get a majority of the due diligence in, and the key, borrower due diligence and the stuff on the property and the third parties, and be able to lock the rate and still sort of have a plus or minus 5% on the loan amount. And so people can get comfortable with that. And so that helps some people. People are trying to lock as soon as they can.
Really. Yeah, I mean, a lot of times the borrower asks, well, how much money am I going to get, and when can I rate lock? I mean, that's kind of the first two questions that people have when they fill out an application as soon as possible. And you got to be a realist on Fannie Mae loans, is that you may not be able to lock for 20 to 30 days from the application. There's a number of things that Fannie Mae has to have or know about you. If you've never done a transaction with Fannie Mae, they don't know anything about you as a sponsor. They know nothing about the borrower, how that's all created, what the history is of the borrower and the group of multifamily ownership and management, the history, net worth, liquidity, who's going to manage your property. There's a lot of things that they have to understand, because to lock this rate, they typically have to get all that information in. They don't necessarily have to have the searches done. The UCC searches don't have to be done, but they got to understand a little bit about the waivers have to be completed. So Fannie Mae requires, if you're trying to get maybe a green program waiver to try to reduce your interest rate because you are going to fix some of the water repairs, electricity on the property, and to try to get some efficiency that way, you can try to get your rate lowered a little bit, or you're trying to get something to do with a lower interest rate. You have to have all those waivers in before they lock. And when you lock the loan, they take a 2% loan amount deposit. So that's refundable if you close. Now, that's if you lock the loan between, say, 0 to 90 days. If you go over 90 days, they'll take a 3% rate lock deposit on those type of transactions. So if we have limited information and we lock the loan, and for some reason that loan is not be able to be delivered to Fannie Mae, they will keep your 2% or 3%. And so not only you may have hard earnest money up there, but you may have hard deposit lock that becomes not a deposit, but actually gets cash by Fannie Mae on the deal.
Yeah, so a lot of people are having to go, maybe 1-2% of the purchase price earnest money day one on some of these transactions. And then now you're throwing in another 2% on the loan amount. So you have a lot of money at risk on these transactions. And so, speaking with a lot of listing brokers, they really want to see a strong general partnership team that has not only the liquidity to qualify for the deal, but in these transactions where you're putting together your sponsorship team, it's important to realize that if you are in this $5 million deal and you're cut by $500,000, that the general partners in the group have the money to put in $100,000, $200,000 each to make sure this thing gets closed. Because not only you have earnest money at risk, but you've already gone out to your limited partners, you've already raised the other portion of the equity, and you want to make sure this deal gets closed because it's sort of your reputation as a GP in front of these listing brokers.
Yeah, Dave, tell us, man, you have a transaction that locked the transaction today. Tell us a little bit about that deal if you could.
Well, this is one of these deals where we initially went in, once it went under contract, we initially were going to do a green program on it. We did initial sizing with Fannie Mae and arrived at X dollars of loan proceeds based on, the current rate environment then, the green program. So once we got into due diligence, we found it really wasn't practical to do the green program. So
why is that?
Well, when you are able to do a green program, there's an incentive to do green. It's kind of a political thing that Fannie's worked on. And so there's an incentive to do green energy savings on your property. So if you can achieve a 25% energy savings, you can qualify for, 25 basis to 35 basis points reduction in your interest rate, which is a great thing to have. Obviously, it's going to reduce your interest rate, increase your cash flow, and it's also going to give you more loan proceeds when you size it. So there's a lot of advantages. However, there's a cost to doing the green program because essentially an engineer will go out there, they will do an audit on the property, they will inspect it, they look at all the utilities, and they come up with a game plan to achieve 25% savings. The easy low-hanging fruit is usually water, so therefore it's usually pretty easy to get your 25% on an older property where they haven't really done any real energy savings previously, and usually at a reasonable cost of getting that stuff done, you'll achieve your green program and qualify for the discount. But dialing back to what we're talking about here, the property that was in question, the owners had done a lot of green stuff on it already, so it wasn't justifiable to go in and spend all that money to get the 25%. So we had to knock out the green program, which of course was a ding on the interest rate. And during the underwriting, we had, the usual things that come up, but it was essentially fairly smooth. But of course, we had the market moving against us during that time. So the interest rates from when we first looked at that property, did the sizing on it, to when we locked today, I don't have all the numbers right in front of me here, but we probably saw, I would say, probably a 40 basis point rise in rates from the original quote, and not to mention the fact that we lost our green energy rebate as well. So, but it was a fairly good outcome. We locked today. We locked at a great rate compared to what a lot of people are getting at the moment. And the other thing that you've got to remember, that when you lock a Fannie Mae loan, and we did a streamlined rate lock for the reasons that James alluded to before, one thing you've got to remember, when you lock, depending on how much time you've got to close, you have the ability to gain up to 5% extra loan proceeds. There's a window of 5% either way. So when you lock a loan, which is going to be securitized on Wall Street, there is actually a 5% variance allowed in the loan amount. So there is a potential to add extra dollars to the loan amount that you locked for if you get another month of better P&Ls, if we get some more reduction in expenses or whatever to gain some extra loan dollars in the sizing. So that's a thing that can happen as well. So Paul, I'll hand it back to you.
James, what's your thoughts?
So a couple things. I mean, everybody's looking at the same 10-year treasury, but sometimes it takes some time for these things to go across the desk of listing brokers and sellers and feel the impact. And so I think right now, I mean, just for a snapshot here in DFW, there's probably 25, 30 deals that are on the market right now. And on almost all these deals, we'll get sort of a whisper price, go size the debt, and come back. And, you know, in the last probably 2 to 3 months, the leverage on these deals, at first it was 75, then it was 70, and now it's probably 65, just with the run up in rates. And so when we're quoting these deals, a lot of times people are saying, well, why is the leverage 65%? And it sort of goes back to the debt service constraint that we talked about. And Fannie and Freddie really are not coming off of that debt service constraint. And so a lot of people are coming to us and saying, well, is there any other loan products out there that are available that can get me higher leverage? And really, if Fannie and Freddie are out of the deal, then you're really looking at bridge lenders. And then once you look at bridge lenders, there's really two types of bridge lenders. One is just your standard bank recourse loan that you could get at a local regional bank, and the rate is probably 5.5 now, and it'll be 5 years fixed, maybe 1 year interest only, and then switch over to 20 or 25 year amortization, but it is recourse to you. The other option is really a non-recourse bridge, and that really starts out at $5 million or higher, and is really for more experienced sponsors. So a lot of people, if it's your very first deal and you come in and say, hey, I want a non-recourse bridge, just because the property qualifies does not mean necessarily that the bridge lender is going to think that you qualify. And so on these non-recourse bridge loans, you really want somebody at least probably 2, 3, 4 transactions, own in that market, have a good gauge on property management. And when I was at GE Capital, that's what we did, was bridge loans, non-recourse. And the things that are important there that are really not in Fannie Mae are, number one, the rate is typically floating. And so let's say your all-in rate today is priced over 30-day LIBOR. It might be 6% all-in today, but then it might reset monthly, it might reset quarterly. And so you're going to have a floating rate the entire time. And so you're going to have to buy an interest rate cap on these bridge loans.
And what does that mean? What's a cap?
The interest rate cap, typically they're going out and locking an index. So let's say LIBOR is at 2.5 or 2.3%. They might go out and lock LIBOR at 3% or 3.5%. And they're really making sure that based on your projections, that if LIBOR increases significantly, that your property is going to be able to service the debt still. And so on these bridge loans, you're still looking at not only the in-place income and expenses, but then they're really looking at the forecasted year 1, year 2, year 3 projections and trying to get an understanding of where you're going to take this property.
Yeah, cap really it's like an insurance policy. Who's taking the risk on the deal? You know, the interest rate risk. Are you taking the interest rate risk, or is the person you're trying to push it off to going to take the interest rate risk? And that, if you're pushing it over to somebody, you got to pay them a fee, like an insurance policy, to take that risk. And the lender wants you to do it because what they don't want to do is they don't want to have these interest rates jump up on LIBOR. Your monthly payments jump up, and all of a sudden your payments of $25,000 becomes $35,000, $40,000 a month. So that's why you take out the caps in these deals. Dave?
Yeah, James and Paul, further to that, I mean, it's funny on some recent deals where they were stabilized properties, they qualified for agency. We went in, got the sizing done, and we were at, as James said, we're seeing 60, 65, max 70% leverage on a lot of these deals. And so the question is, how can we get more loan proceeds? So, well, we can go to a bridge loan and maybe go to 75. So you might capture another 5 to 8% extra leverage. But what a lot of people are looking at, they're dialing back and going, well, hang on a second, I'm going to get this bridge loan. And apart from the interest rate risk with it being adjustable, you've also got to look at your exit. So you get a bridge loan on a property, you squeeze another 8% of leverage out of it and loan proceeds. It's probably going to be at a higher interest rate out of the gate, maybe adjustable from the original Fannie Mae quote. And then in 18 months to 2 years' time, you've got to look at what's the risk there. I'm going to be selling in maybe a higher interest rate environment, or I'm going to be refining into an agency loan, and what are the rates going to be then? So a lot of guys are going, you know what, that 65 is not looking too bad. You've got a 10 or 12-year note. It's a safety blanket. You've got security. And remember the other thing, you might be at lower leverage. If you do a Fannie Mae, there's always the supplemental option later on. If the property improves, you can capture some more loan dollars with the supplemental. And also the loan's assumable. So, you might get a little bit of lower leverage at the beginning, but it'll soon be mitigated by the supplemental and the ability for the loan to be assumed, and it could be a very attractive deal later on.
What do you think about that, James?
Well, there's a lot of deals actually on the market right now where there's two prices. One is if you assume my Fannie or Freddie loan at 4.25, which looks pretty good right now, and the leverage is already 70%. So on these assumptions, people are able to buy the deal. The loan amount's already fixed, and then the interest rate is fixed. And so you're coming in, assuming the loan, and that's taking some of the risk off the table. Of course, there is the supplemental piece that is at risk that is not locked. And so we've done probably 4 or 5 loan assumption supplementals in the last 2 to 3 months. And that's becoming more and more common because it allows people to know what their sort of yield going in is based off of the existing loan. And on those, you have to remember, there's a couple of rules. You have to remember that, depending on the number of years to maturity will determine your leverage in the transaction. And then also you want to make sure that you can only go back to the existing lender for that supplemental. And so making sure that when you're underwriting these deals, making sure who the lender is, and then also what their appetite for a supplemental is, and compare that to your experience versus the sponsor's current experience.
Yeah, let's go through that one more time again. Again, if you're looking to buy a property, the person has a Fannie Mae loan against the property, and that person, the seller, may have taken it out, say, 2 years ago. So he has a little bit of a longer runway for you to assume the loan on the property. So there may be some interest only still involved on the deal, maybe not. Okay, but then you can assume his first loan. I mean, the horse is out of the barn. We're just changing jockeys on the horse, and then we're going to add a supplemental, kind of a second lien to the property. And what the benefit is for the seller, and just like James says, there's two prices. The first price is you have the seller pay off that loan and have them incur a yield maintenance penalty, a large prepayment penalty. Or the second price is have you just assume the loan against the property. So in that example, if let's say the prepayment penalty was $1 million, then the new debt price is $11 million. But if you assume my loan, it's $10 million. Yeah. And so they might have, let's say their loan outstanding is $6 million. And so right now you're at 60% leverage. But what the current lender is going to do is go size the supplemental, and the value and cash flow should have improved on that property since that original loan was put on. And so they're going to size it to a 130 debt service. So we talked about the 125 before. They're going to size it at a 130, and you can go up to 75%. So if your purchase price is $10 million, you can get up to 7.5, which would be a $1.5 million supplemental. And in today's market, even on new debt, you're not able to get to 75% on a lot of deals. And so you have an assumed loan. Let's say that $6 million loan is at 4.5%. And now you're putting on the supplemental, which might be at a higher rate, let's say 6%. But blended, you are at a lower interest rate than a new deal. And you're doing a transaction right now where the first lien was at 412?
4.2 in that range.
4.2. And if we're thinking of interest rates continue to rise, and they continue to rise. So even if you were to, say, bypass a bridge loan and actually go with a Fannie Mae long-term 10 or 12-year term, and having the lower rate even today, if you were locking a deal at 5.25, 5.20 or somewhere in there, I mean, that rate could be a lot lower than what the future holds for you too. So look at it a couple different ways. Again, Fannie Mae is kind of the Cadillac of loan financing, but again, you cannot lock it up front. So talk a little bit, James. Let's talk a little bit about folks that don't qualify for a Fannie Mae loan, but maybe qualify for a Freddie Mac loan. Tell us a little bit about the benefits for some of the newbies that want to get into apartment financing, and talk a little bit about locking rates.
Sure. So on Freddie Mac, really on the small balance program, they're looking from $1 million to $7.5 million is the sweet spot. And you're going to need the property. They're putting probably 85% of the credit request on the property. And so they're really looking at that property in terms of the condition of the property. Is there any deferred maintenance on the property? How much CapEx is needed for that deal? And then is it stabilized? So you're really looking for 90% occupied for the last 90 days on Freddie Mac small balance. And then they're looking at the borrower after all those conditions are met. And so they're really sizing to a 125 on Freddie Mac small balance. And then let's say you as the borrower maybe not have multifamily experience, but you have the net worth and liquidity to qualify, then you're able to qualify for Freddie Mac small balance loan and lock in that interest rate at the very beginning. So let's say you locked it in today, day one, you send in the loan application. You have 35 days to get all of your property due diligence, your borrower due diligence into Freddie Mac in order to hold that rate.
And that's 35 business days.
Okay, 35 business days.
sure.
Yep.
Yeah. So, Dave, any other questions or comments on the Freddie Mac small balance? I mean, you do a lot of the small balance business down in Central Texas and throughout the United States. Tell us a little bit about the benefits you like from that Freddie Mac small balance for groups that maybe don't have the experience level.
Yeah, I mean, it is definitely a great product. And the Freddie Mac small balance product was designed specifically for the smaller loans and compete with banks. So that's kind of how they designed that product. It is a great product for people that may not quite have the experience with regards to a Fannie Mae loan. Mm-hmm. And usually if the borrower has got decent net worth and liquidity, maybe they've owned a little bit of real estate, they live within 100 miles of the property, there is a good chance that they may be able to self-manage, or at least they can just get away with hiring a third-party management company, whereas that may not necessarily fly with Fannie Mae.
Yep.
And obviously the other thing with the Freddie Mac small balance, and in a main market, where it's a non-tertiary market, like a main market, you're going to get 3 years of interest only out of the box, typically. And as James said, your interest rate is locked up front. And it's funny, I've got several deals right now where we started off with a Fannie Mae, and both guys have jumped to the Freddie Mac program midstream.
Oh, is that right?
Yeah, the reason being is we saw the 10-year, and right now, and this may change, obviously, this is not guaranteed, but right now we found the Freddie Mac small balance program in this particular market of that loan size, it was 15-20 basis points cheaper in rate than Fannie Mae, and you can lock it up front. So these guys jumped over, they've got their term sheet signed, and they're locked in for 35 business days. And once again, as long as that loan is underwritten and it is submitted to Freddie Mac within 35 business days, that's your rate. So, it took away a huge
interest rate risk.
Absolutely. So it's funny. There's 2 deals in the last 2 weeks where that's happened, purely because of the comfort level with a known interest rate.
Yeah. Again, if you've never done an apartment loan, we just want to give you some insight, a little bit about where we're seeing the market at. James, anything to add?
Yeah, I mean, we've been pretty harsh on, interest rates going up. So I just wanted to hit some positive stuff here.
Okay.
For a little bit. So if interest rates are going up and people feel like a recession's around the corner, why are there so many people trying to still buy apartments? Mm-hmm. And, the reason interest rates are going up, a lot of it has to do with that we're at full employment, right? Yep. So unemployment's at, 30, 40-year lows. They think inflation's coming. So when there's full employment and you go try to hire somebody right now, let's say the maintenance guy or even somebody at all these white collar jobs, there's nobody there to hire. Mm-hmm. And the only way that you're going to hire somebody is pay them more. And so the thought is that wages are going to increase. And then once wages start increasing, then these rents we have a chance to raise rents. Right. And they're going to have to absorb those rent increases. And so that's the reason people are still buying apartments, is that the demand is still there. As interest rates go up, these houses that we talked about, these single family homes, are going up.
Yeah. We talked about that little sound clip from Hill Street Blues from 30 some years ago. And if you go back to interest rates in 1981, and when I was just coming into the apartment and lending and banking business, interest rates on home loans were 16, 17%. Prime rate was at 21%. And so I would be jumping out of windows to get a 5.2 or even a 5% or a 5.5 rate. It's unbelievable. So everything goes in perspective, is that where we think the interest rate is going higher, it's in the bigger picture of things, it's not. I mean,
relatively higher.
Relatively higher.
I mean, compared to yesterday.
Compared to yesterday.
But yeah, in the big picture, it's still a relatively low interest rate. The demand for apartments is still there, and we've seen it in Dallas a little bit. I mean, definitely on the coast, just the affordability on the single family side, as interest rates go up, and the cost of housing and building new housing goes up, there is a deficit on the housing affordability side of the BNC stuff that we buy. And that's why these things are still full. And, I think prices have come up pretty quick and rents have come up, but just not as quick. And so I think there's going to have to be a little bit of a shift. Maybe pricing goes flat for a little bit, but rents catch up.
That's what I see it. James and I had a discussion with some top producing sales brokers here in the Dallas-Fort Worth area yesterday, and we were my opinion is that we're kind of seeing a tsunami right now that's going through with interest rates rising, in that it's going to maybe hurt a number of transactions at the beginning, but then it'll become the new normal. And just in the short term, we'll see people scrambling to change loan programs or lock transactions quicker or bring more equity, but hopefully it will reprice the market a little bit for maybe a little bit lower prices for maybe some more people to get into these transactions in the future.
There's always a gold lining to what happens. And if you sensibly size your transaction, do your homework, I always say that you can make more money out of a deal by paying 6% interest rate on a loan if you buy it right and do your research than overpaying and not doing your numbers right on getting a deal where you've got a 3% interest rate. So an interest rate on a good loan is a line item on your spreadsheet. And if you do your research and you buy wisely and do your numbers correctly, there shouldn't be a worry.
Professor Eng, is there any other words of wisdom as we close out this podcast of, be careful out there?
I think if our standard or typical, most people are taking the Fannie Freddie stuff. The question I always ask people when they're looking at bridge loans is there better be a very clear value add story that you can execute. And day one, you close. Day two, you better be in there with your CapEx, getting it done and getting ready to refinance or sell that property in 12 to 18 months because the clock is going.
That's great. Some great information. Now, again, we have thrown it out there. If you are in the middle of a transaction, we'd love to be your lender to take a look at it. But if you want us just to give us an opportunity to take a look at the deal, we want you to kind of do your own math and size up a transaction that you have an interest in. Kind of throw it over the fence. Let's take a look at it, and we'll give you, 20, 30 minutes of our time just to make sure that we're all on the same page and see maybe we can finance it, but maybe give you some, this may not be the deal for you, but maybe give you some words of wisdom of what we're looking for when putting together financing on a transaction. Things I just want to make sure that you remember is that we do have a 17-page white paper report, so go onto the oldcapitalpodcast.com website. Make sure you go onto the oldcapitalpodcast.com website, download the 17-page white paper report. It was a paper that James Eng, Michael Becker, myself wrote, and some good words of wisdom on when you're trying to structure a loan for a property you're looking at. The second thing is that if you are on iTunes, please give us a thumbs up or a like. We would definitely appreciate that. We appreciate all the kind words. We were out in Nashville, Tennessee last weekend at a Jake and Gino summit out there. We probably had 300-400 people over there. A number of people listen to the podcast. We do appreciate that. It was good to stand up and meet some people that we talked to, names with faces out there. So we appreciate being at the Jake and Gino seminar. Dave, anything else to end?
No, that's good. I think I think everything is looking good, and I think this environment we've got right now, we're going to see some great deals and some great opportunities for acquisitions down the line. Sounds great. Dave Walls and James Eng, thanks for sitting in. We appreciate it. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.